Hello, I'm Dr. Ahmed Whitt from the Center for Wealth Equity at Living Cities. The next 18 months represent a once in a decade opportunity to shape where billions of dollars in capital goes and whether that private capital actually advances your community's priorities. I'm talking about opportunity zones. The 2025 tax bill made opportunity zones permanent. And through that incentive, your state will be selecting entirely new zones by July of 2026. Let's talk briefly about what opportunity zones are. Opportunity zones are a federal tax incentive that allows investors to defer and reduce capital gains taxes. Now, those are the taxes on profits you would earn from selling assets like stocks, real estate, or businesses. And through the Opportunity Zone incentive, investing those dollars into economically distressed communities entitled you to three key benefits. One, you can defer the capital gains taxes for 5 years. So, in other words, you get a multi year extension on your taxes, allowing you to reinvest your earnings. Two, you reduce the overall tax burden through a basis step up. What that means is, let's say you were to earn $100 of profit. Instead of paying taxes on that $100, you would pay either taxes on 90 of those dollars through the standard incentive, or now with the rule extra incentive, you would only pay taxes on 70 of those $100. Now, in addition to that reduction, the third benefit is that you will eliminate taxes on any future gains after a 10-year hold. If you're making investments and you hold on to those investments for over 10 years, you're not going to pay any additional capital gains taxes on the extra money you earned during that period, or that money that you're reinvesting that you've earned. The original goal of the incentive was to direct patient, risk-tolerant capital into historically excluded neighborhoods. But as we learned through the first round, even with the incentive, just having the capital doesn't guarantee that it's distributed equitably. Let's talk a little bit about what changed in 2025. With the federal budget, we've started what we could call Opportunity Zones 2.0. Four major things happened. One, there's now rolling 10-year designations. So your governor is going to select new zones every 10 years starting in July. Number two, the second thing that happened was that there's a more focused or narrower eligibility. So only census tracts with median incomes below 70% of the area or the state median qualify. Previously, there were some loopholes that allowed for certain high income or tracts that were adjacent to the target tracts. That's now been closed. The fourth thing that happened in the 2025 tax bill, there are now stronger incentives to invest in rural areas. As I talked about before, you're going to receive a 30% basis step up after 5 years, as opposed to the 10% in a standard zone, or what has predominantly been urban areas previously. The fourth thing that happened is there's additional support, and by support, I mean dollars that have been put into transparency and reporting in Opportunity Zone funds. Under the new rules, Opportunity Zone funds must report project level data to the Treasury and to the IRS. And now there's penalties for non-reporting of these new metrics on jobs, compliance, and community benefit. So all in all, these four enhancements are a fundamental redesign that creates a really narrow window for strategic intervention by nonprofits, by cities, and impact investors to ensure that the capital flows where there's a greater opportunity to support an inclusive economy building. Couple of things that we learned from round one, or Opportunity Zones 1.0, that we want to be mindful of with the present opportunity. Independent research has shown that Opportunity Zone capital predominantly went to places that were already attractive to private investment and to project types that did little to expand affordability or ownership. For example, A report that Urban Institute did using Ohio data showed that the majority of Opportunity Zone equity went into market rate multifamily and commercial projects. So very little of that capital actually reached to affordable housing or small business opportunities. In that same research, the researchers found that 80% of the Opportunity Zone finance units were rented above the median rate for that census tract, meaning that there were new units, but they were out of reach for the typical neighborhood residents. Certainly, capital that would not have otherwise been directed to certain areas flowed there, but often it bypassed the communities that we believed would benefit the most by the opportunity. In this cycle, especially between now and July, it is really pivotal that we use our resources to influence where there's going to be the most impact for the dollars. Given that research, that is why your role in 2026 is pivotal. Governors are deciding now that next map for opportunity zones, and oftentimes it's happening with very minimal community engagement. The opportunity now is for local leaders to organize early and speak clearly with a data-driven voice. So let's give 3 action steps for this round of opportunity zones starting right now until July 2026. One is to influence which tracks get designated. Governors are going to have to submit their new zone designations in the next 6 months, and many are going to rely on state economic development agencies and consultants. Those teams need more robust data and political cover from stakeholders like you and me. So the opportunity for influence, particularly for nonprofits, for community development, financial institutions, and impact investors, are to help identify priority tracks where investment is going to reinforce local plans, not create new ones, and not to displace them. There's tools like Urban Institute's zone selection tool and other mapping platforms that help city leaders and other stakeholders flag Goldilocks tracks, tracks that are distressed enough to qualify under the rules, but have assets existing like anchor institutions, existing small businesses, or transit hubs that will make the investment more viable. We want to be able to present governors with a ready-made slate of candidate tracks that are explicitly tied to local comprehensive plans, anti-displacement strategies, and racial equity goals. Number 2 is to build an investment-ready pipeline now. Capital follows deals, not intentions. Communities want opportunity zones dollars to support affordable housing, quality jobs, minority owned businesses. Those projects must be structured, underwritten, and very close to shovel ready by late 2026, early 2027. That's when the new zones are going to take effect. And that's when investments are going to be lining up for their next wave of deals. For different roles in the ecosystems, there's different things that we can do. For foundations, we've learned from Opportunity Zones 1.0, there's a great benefit to offering pre-development grants or recoverable grants that help community developers assemble sites, line up partners, and fill early stage gaps that commercial capital wouldn't touch otherwise. For cities, there's a lot that can be done to help streamline permitting, to provide land or tax abatements where appropriate, and to align zoning so that priority projects and target tracks can move quickly once the capital is ready. Impact investors can structure blended capital vehicles, combining concessionary, guarantee, and market rate tranches that de-risk community center projects while still delivering competitive returns. The third action step we can take is to use new data to enforce accountability. The upgraded reporting rules mean that there will finally be systematic project level data on where opportunity zone investments go and what exactly they finance. That creates an accountability tool in the hands of local leaders. With that tool, we can do three things. One, we can start to track which funds are delivering clear community benefits, such as affordability, living wage jobs, and local ownership. And we can also track which ones are actually extracting value with minimal local upside. Two, we can publish public scorecards that name and celebrate responsible capital. Also, we can call attention to projects that are undermining equity goals or causing displacement. And the third thing we can do with this new accountability tool is to use the data to push for further policy refinements in the next 10-year cycle, whether they're community benefit standards or deeper incentives for projects that actually build wealth for the resident. Opportunity zones are now the nation's largest place-based federal economic development incentive. And over the next decade, they're going to determine which neighborhoods see an influx of private capital and on what terms. The question is going to be whether your community will be organized and ready to shape it. Let's make sure that this time, the incentive helps build wealth with communities, not just wealth from communities.